Hey everyone, me Kevin here. We're all wondering when the heck the great crisis is going to end that we have been stuck in if you've been in any high multiple stocks since approximately February 19th. In other words, if you've been investing in the same stuff that Cathie Wood is investing in, or even stocks similar to her, you've kind of in the last 2 months been like, oh man, I just lost lots of money. And this is no shade on Cathie Wood. We love Cathie Wood and we're huge supporters on this channel, but the point is, right now there's a huge rotation away from any high multiple stock, and we are seeing it over and over again. In fact, anything high momentum, which lately high momentum has really been associated with high multiple, is selling off like crazy. SPACs, which are extremely high multiple because a lot of them aren't even profitable, huge sell-offs. I mean, look at QuantumScape down 13% today. Sure, they had a short seller report, but that's coming while they're at the bottom, basically. Now they're getting pushed down even further. You got Gevo down 9%, Nano Dimension down 8%, Canoe down 7.5%, Rite Aid is down, Virgin Galactic's down, Blink is down, Li Auto's down. Anything that basically has ever been mentioned on Wall Street Bets, it's almost kind of just like big middle finger. And it's painful. Churchill, SOS, Arcimoto, BNGO down 4%. I mean, anything momentum related down today. GameStop down 2%. I think the only momentum doing decently today is AMC, coming after some positive commentary from the CEO. But beyond that, everything else is getting spanked, and even AMC has had a little bit of a sell-off during the day today. And so why is this happening? Why are we seeing a sell-off in high multiple stocks? Unless, you know what, the easiest way to do this is let's do this. Let's write this down, because it's ridiculous, kind of almost what's going on here. So here's what we're seeing. We're seeing high multiple, so I'm going to put high PE, price to earnings, stocks are down in the gutter. Okay, so at the same time as we have high PE stocks down in the gutter, what else is happening? Yields? Well, yields on the 10-year, so basically 10-year / bonds, are plummeting, which is ironic. Like they literally, I think it just broke 1.53%. It did. The 10-year just broke 1.53%, which when this all started in February, high PE stocks were selling off because bond yields were skyrocketing. Now bond yields are plummeting, and because people are buying bonds again, or companies or banks or whatever buying bonds again, and the high multiple stocks are plummeting. At the same time, you have home refinances. I'm just going to put refis. People taking out way less money than they ever have in the past. You're seeing only about 30% of people refinancing actually doing what's known as a cash out refinance. Then at the same time, banks today, banks complained that lending is way down. And I'm not just talking real estate lending here. I'm talking about consumer lending, whether that's cars or credit cards or lines of credit, portfolio lines of credit, whatever. Bank lending is down. The banks are like, yo, this is like a profitable segment for us. And yeah, lending's like way down. Like we're totally open for business here, willing to do some more loans, but nobody's coming. Like we thought if we build it, they will come, but they ain't coming. Yeah, so look at this disaster. High multiple stocks, which also includes no earning stocks. So if you're wondering, like, why is like a CCIV down? Let me make it very simple for you. How many cars has CCIV sold? Bingo. 0, okay? So until companies actually start proving their earnings, you gotta be suffering in these high PE stocks. These high PE stocks, this is the period of time where high PE is going to have to prove themselves. But what out of everything is up right now? Well, the S&P and Dow are up, and that's because the lower multiple stocks are running like crazy. I mean, you've got Apple and Amazon and Google actually doing pretty dang well. Nvidia, which is one of the lowest multiple growth stocks, doing pretty well. I mean, you're paying 40 times future earnings for this company. That's a far cry from, you know, the 3-figure multiples you're paying for companies like Tesla or Enphase or some of these that we think will have more growth than Nvidia. They're going to have to prove themselves because they're already priced so high. But anyway, so you've got high PE stocks selling off, bonds going down, which is totally weird. At the same time, people are taking out less debt. But in February, we hit record high levels of margin, around $817 billion worth of margin in America. Folks, we have never been above $700 billion in margin since basically November. In November, we broke 700 billion in margin, and we've climbed up to 800 billion in margin. Take a look at the recent trackings. Now we could just simply go to FINRA to take a peek at this. Look at this. So here's January, February. You can see we broke to $800 billion in margin debt. And if you just look around here, all of these other dates here, with the exception of here, November 2020, all of these other dates, it's always around 400 to 600 billion. Here's lots of 500 billions in 19, 600 billions in 18, 500 billions in 17, 4 to 500 in 16. Okay, you get the idea. Like, we could literally just keep scrolling here, and it's even smaller over here, but the numbers become a little less relevant when we scroll all the way down like this. So anyway, with recent debts in margin, we're like at all-time freaking highs here with margin debt. And so let's go back to the sheet here. Wait a minute. So high multiple stocks are selling off. Bonds are selling off, and people are taking on less debt. This right here is a little bit starting to rhyme with what something Mr. Ray Dalio likes to say, and it's also something I've talked about on this channel. What have I talked about on this channel? That this decade might become the frugal decade. Well, as part of being frugal, the frugal decade, you could see the blend of the frugal decade and Ray Dalio's beliefs, which Ray Dalio's beliefs are the great deleveraging. Yeah. In other words, people wanting to get the heck out of debt. It makes sense. It literally makes sense. Look at this. High PE stocks, down. High multiple stocks, people taking out maybe less debt to basically borrow and buy these high multiple stocks because, well, they also haven't been really performing super well really in the last 2 to 3 months. They've just been getting spanked over and over again. It's literally been like, hey, high PE stocks, spank, 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 spank. And then we get a little bit of green. But what we don't know is it's just really the suits resting their hands and their gloves a little bit that just come right back. And, oh, did you enjoy those 3 days of a break? Good. It's pretty bad. It's pretty ugly. But anyway, doesn't it make potential sense that what's happening in the markets right now is a potential deleveraging of these massive amounts of margin? Which, think about it. If we hit record margin levels in November, between October and November, basically right around the election time, people went deep into margin, plowed money into stocks. We got this big November, December, January boom. Now all of a sudden the rate of margin growth is slowing because you can only take out so much margin. I mean, watch, you could literally see the rate of margin growth apply to what the heck is happening in the world here. Look at this. Here, in fact, you know what? Let's do this for giggles together. So let's pull up a generic spreadsheet here together because it's kind of shocking. So here we go. Margin and spreadsheet. All we have to do is do a quick little simple calculation here. Watch this. All right, here we go. So all we're going to do is we're going to type in October, November, and maybe we can reverse engineer how long it's going to take to fix all this crap. February. Okay, here we go. So we were at 659,313 over here. This is billions of dollars. 722 billion, 118. We got 7. I guess it's millions, but it depends on what you read. I just read the first 3 digits and then I call it billions. So 798, 605, 813. See how slow that growth is already over here? I mean, just intuitively, when we look at it, it's like, wait a minute, we added like $70 billion over here, $70 billion over here, $20 billion here, and not even $20 billion over here. So let's just do a percentage difference. So if we do this number divided by this, turn this into a percentage minus 1, we're going to really see a massive slowdown. And this was before the crash. This was before the madness. So let's drop in a percentage over here. Go to a couple decimals, minus 1. There we go. So we saw a 9% increase in margin from October to November. From November to December, we saw a 7.7% increase. then a 2.6% increase, then a 1.69% increase. I bet you, I would not be surprised, and these numbers come out in a week, I would not be surprised to see this number go back under 700, and we end up having negative margin growth in March. This information will come out on April, I believe, 21st or 22nd. But anyway, I would not be shocked to see negative margin growth because it would make sense. Look, folks, high PE's down. Why borrow to buy this stuff? I mean, I like buying stuff when it's cheaper, so I've been buying. But at the same time, I've also been on a mission to pay down margin. Today, I'm at 24%, including the red that we've seen in the market today. I want to get that to under 20%. Still got some work to do. This is a lot better than where I was, a couple months ago. But so, been working on it. I've been chugging along. But this all makes sense. High PE down. Bond yields down. So you'd think when bond yields are down, people would plow money into PE. But no, we've been shell-shocked. It's like, no. I need, margin, no bueno. We had our little scare. We had our March scare. You know what? We're good. We're just going to pay this margin off. That's why we're not seeing as much money come out of real estate. Siri, we've had a conversation about this before, okay? Bank lending, down. People don't want debt anymore. And what have I said on this channel? People are going to be more aware of their money in this decade than ever before. My argument with the frugal decade is that people are going to realize what the K-shaped recovery really means. The K-shaped recovery means, first of all, you don't get caught with your pants down and a bunch of debt and a 100% margin when the market falls. That's how you get screwed and you fall right back down to the bottom of the K-shaped recovery. But people also understand now that people with businesses, real estate, and stocks win, and those who don't have real estate, stocks, and businesses lose. And that, in my opinion, is going to lead to a frugal decade. Whether that is paying down debt or spending less, that's been my argument. And I've been saying this for a year now, that we're going into this frugal decade. Ray Dalio has been mentioning the great deleveraging for a few years. Now, the great deleveraging, Ray Dalio takes this a little bit further because I don't think right now we're yet in a great deleveraging. I think we're in a deleveraging. But a great deleveraging is spawned by interest rates going up. When interest rates go up, debt becomes more expensive, and nobody wants to take on debt, especially at that point. And then all of a sudden, people are forced into deleveraging. But really, what we're seeing now is kind of like phase one of that. It's kind of like, well, we do think rates are going to go up soon. Everybody's watching what Jerome Powell's saying because we're all like, oh man, when's the punch bowl going away? Folks, we're in a deleveraging. That is what we are in right now. We are in the combination of a frugal decade, a deleveraging, and people running away from debt, people running away from margin. I kid you not. If I could place options on this right here, or make a bet that margin debt is going to plummet when this new data comes out, I think I would make some pretty beautiful tendies on that. And I think we are going to continue to see this until we get back to normal levels. And so that helps us understand a little bit, okay, well, what are normal levels? Well, take a look, folks. Normalized levels. Let's just look at the average. Let's find like what we think is a reasonable average here. What would we say? Maybe 600 billion? I think that's about the midpoint of 2020. We were somewhere, 600 was a high in 2019. In 2018, we probably had an average, and I'm just spitballing this really here, somewhere around, or I should say eyeballing, somewhere around 645. So let's say we even want to go down to 645, okay? That's a 2018 high. 645 is a 2018 high. It's higher than anything we had in 2019, and it's about an August level of margin, which is when we had our last run. So let's say we wanted to get back to 645 billion dollars in margin, and we were able to pay off about 3% margin per month. Okay, how long is this going to last? Okay, there we go. I made the formula. So we'll take this formula, and all we're gonna do is we're gonna paste this down. We're gonna keep going until we get to 645, okay? Let's keep going. Boom. September, October. September or October is potentially where the drama ends, if this is a deleveraging. If I'm correct, and this is a deleveraging, we have to wait until September or October for this pain to end. Which means you've got 6 months of pain and 6 months of buying potentially cheap. Unless you're high in margin, then you should pay down your margin. But what else does this align with, folks? Think about what else this aligns with. What's really, really incredible about exactly what this aligns with is what we believe might happen with inflation and rates. Because take a look at this. You might remember this from a prior video I made. Take a look at this. So this is a chart I made on my expectations for inflation. We talked about this a few days ago. I mentioned that I believe that year-over-year inflation will come in at 2.4% for March. It came in at 2.6%. I was really close. That's really close. 0.2% there, a percentage point difference. So I believe that we're going to see inflation go up to a year-over-year amount of that 3.5 to 3.4% in April, May. We are going to see inflation. I don't want anybody to confuse what I say with there's no inflation. There is inflation, and we are seeing inflation. I just don't believe it's going to be permanent. Now, this is obviously where a lot of folks differ with me, and that's okay because I respect the other opinion as well because it's one I have to be aware of. The belief is that if inflation goes up to 3.5, many believe that inflation is going to continue to trend up, and we're going to see this maybe 4, 5, 6% inflation level. Fine, that could happen. We will know that probably with certainty sometime by when we expect there should be an inflection point, which we expect the inflection point should really be over here, around August, July, September. And what we're looking for is inflation staying high? Is inflation going to 4, 4.2, 4.3, and how fast is it accelerating? Obviously, going from 1.7% to 2.6% right here is a big bump, right? But that starts to slow. And when we see that slow, is it going to slow at 3.5, 3.4? Is it then going to fall down quickly as we remove the base effects? Or where is it going to level off? Once we see that leveling, that's when we have the inflection point where we go from rapid changes in inflation, like an accordion, rapid changes in inflation, to soft, smooth changes in inflation. And are those smooth changes going to level off around the 4 to 4.3 range, in the mid 3s, or in the low 2s? That's what we want to be concerned with. The point is, we don't actually expect that to come out until August through October. What's so weird about that, folks? We literally just found a potentially corresponding argument as to why this massive volatility and essentially this feeling of a market crash could continue until September through October. People, while we are waiting to see what happens with inflation, people in general as a society are deleveraging. They're taking less loans from banks, they're taking less money out in cash out refinances, and the rate or the acceleration in margin has already ground to an essential halt. I believe it's going to reverse. It's going to fall by approximately 3%, maybe more. Hopefully more. Hopefully it falls by more. Hopefully it falls by 5 or 6%, but it depends because it's hard to pay off margin when your stocks are plummeting, right? Because that means you're paper handing. It means you're selling at the bottom. It sucks. But if we see this deleveraging until September and October, and we expect that inflation inflection points, folks, for anybody who ever wants to know how long could this crash last, we're in the 4th month of the year right now. We got to get to 9 or 10. That means we have to wait 5 to 6 months, potentially, to see our favorite high multiple stocks actually see some love again, potentially. Now, I don't want to sell and go buy some other stocks and then come revisit my stocks in the meantime because the market moves before we anticipate. Usually, if the market can start pricing in the belief that maybe inflation is trending down, maybe the deleveraging is done. Once the market starts feeling that and the market starts going, ooh, there's some cheap deals over here, we're going to start seeing that price increase again leading into September and October. That's my belief. I strongly believe this, and this is how I'm investing right now, is I'm investing with the belief that we're going through a deleveraging, we're going through a de-risking. We're not going through some, epic market crash, epic market bubble, exploding. This is just the slow bleed. And a slow bleed feels a whole lot like a deleveraging. Folks, if you like my perspectives, check out the programs linked down below. Thank you so much for watching, and we'll see you in the next one.